This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the latest episode of the AJ Bell Money and Markets podcast, your program all about investing, saving, and understanding the world of finance. I'm Dan Coatsworth, and joining me today are Charlene Young and Laura Suter. Hi there, both.
Hi, Dan. Great to be here.
Hi, everyone. So we promised you an ISA special, and we definitely are bringing that with the podcast today.
From whether the different accounts are still fit for purpose and where people are investing in their ISAs this year to becoming an ISA millionaire. And we've got a fantastic quiz as well, all about this favourite topic.
That's right. We're really spoiling you this week. We've also got a chat with Craig Baker from Alliance Witan on how the newly merged trusts, the Alliance Trust and the Witan Investment Trust, are getting along.
But before we get into any of that, we will start the show, as we always do, with covering off what's happened in the markets this week.
Yeah, it's been a bit of a bumpy ride in stock markets lately, and investors are facing some serious turbulence. Dan, can you break down what exactly has been happening?
Yeah, so we had a pretty miserable start to the week for stock markets, particularly in America. The key word on everyone's lips was recession. So obviously we had Donald Trump. He's only been in power for 7 weeks, it must be, so far. He's been talking about his great policies that could potentially drive the US economy. But already people are thinking, actually, no, that's not going to be the case. You know, what he's doing could potentially hurt the economy. Because we've had yet more stuff about tariffs. Every day there seems to be something new. And in fact, even during the day, the rules seem to change at the moment. So it's no wonder that investors just don't really know what's going on. Companies don't know what's going on. Investors don't know what's going on. So all this uncertainty is causing people to, slightly panic. And we've seen sell-off in some of the things that have done very well in recent years, like particularly technology stocks, things linked to AI, semiconductors, they've all had a really terrible time in the last few days, and actually year to date. That these are the sort of some of the worst places in terms of performance that we've seen. Tesla's shares have halved this year alone. I mean, that's pretty incredible, isn't it? So you've gone from Elon Musk, who runs Tesla, obviously becoming Donald Trump's seemingly right-hand man. His association with the new US president initially was thought to be a good thing. Everyone's going, well, will this open new doors for Tesla, get preferential treatment? Now, people are just slightly getting a bit fed up at him sort of butting in all the time and sort of trying to believe this, be this political figure. And so there's this association now with the Tesla brand. People saying, I don't want to be seen to be driving a Tesla. Perhaps for some people, if they don't agree with what Elon Musk has been saying. It looks like it's hurting sentiment. People worried that's going to hurt sales. We've had airlines in America already warning of lower domestic demand and seeing the impact of US government cuts. So it is been very tough for investors. But all I can say is, whilst a lot of stuff has been struggling, there have been some positive areas. Healthcare, utilities, stuff like Cadbury's owner Mondelez has been doing very well, these sort of staples. And so it's just the usual thing that we always talk about is there is always noise going on in the markets. You just have to try and make sense of it and don't panic in terms of fiddling with your portfolio just because of whatever's in the headline today, this afternoon, this evening.
Yeah, I think that's a really good kind of nugget of wisdom there. What some people might label a sell-off, other people label an opportunity. So like you say, kind of try and keep a calm head if you can. Now, we promised you an ISA special. Let's shift into ISAs. There are so many different types, but are they still fit for purpose, Laura?
Yeah, that's a great question. So we thought we'd run through the different types of ISA and talk about the pros and cons of them and where they might be useful. So let's start with one that's closest to our heart, the stocks and shares ISA. So Dan, are you giving it a big thumbs up or a thumbs down?
I'd have to say, of all of them, a massive thumbs up. I think it works perfectly. You can put up to £20,000 a year into it. You can take your money out whenever you want. No restrictions and withdrawals. Everything that you make inside in terms of capital gains or the income you receive from any dividends, all hidden from the taxman. You don't have to lose out any of that, or you're keeping all of your gains. The average person doesn't use up that full allowance. So, each year. So I think it's, it is absolutely spot on in terms of its current structure. And actually, we at AJ Bell, we talk about simplifying ISAs. I think that if you had to take any of them, this one is fine. It's probably the easiest one for the debate, really. I don't know what everyone else, whether you agree with me or or you think, yeah, this is good.
The best ISA by Dan Coatsworth there. Yeah, no, absolutely. I think, like you say, it's the one we're the most kind of familiar with, closest to our house. And just if you are looking to get invested, you've got that generous allowance, and it is all tax free. But what about the cash ISA? That's made a bit of a comeback in recent months and years, but it's now subject to quite a lot of speculation about its future. Is the Chancellor going to tinker with it? Laura, are you a fan or not of the cash ISA?
Yeah, you're right, Charlene. It was very much the forgotten about ISA, I think, a few years ago. But as we've seen interest rates rise and more people breaching that personal savings allowance, so the amount that you can earn tax-free from interest on your cash, suddenly it's now the hot new thing in the ISA market. And that means the government is rumoured to be looking at it and kind of curtailing it. So I think it's a great product. It means that people can have cash savings without paying tax on that interest. And we know that cash savings are important. People need it for their short-term spending needs, for their emergency pot. And we're a nation that loves cash. So to give people the option of having that tax-free and not having to hand over any of that interest to the taxman has got to be a great thing. But I do think that a lot of this debate around what the government's going to do does tap into one of the issues that we have as a nation, which is that we just hoard too much cash. And all of the figures that come out show that loads of people have really, really healthy amounts in cash ISAs and don't have anything in a stocks and shares ISA. And that's part of the problem that the government is perceived to be trying to solve, getting more people investing. So I think it's a great product, but don't overlook the other ISA options out there just because it's kind of the simplest and easiest to understand, I would say.
Thanks, Laura. I mean, obviously, I'm a parent. I'm sure many of our listeners are. Hopefully, you're well versed with the benefits of the junior ISA. But I do get the impression that they're not as widely used as they might be. So, Charlene, what do you reckon?
Well, I'm not quite sure about that. I had a quick look at the stats yesterday for another article I was writing, and I think it was around 1.25 million junior ISA accounts had money paid into them in the most recent tax year we have data for. Now, the HMRC data lags quite far behind because of the way ISAs are reported. So that was for 22-23, and £1.5 billion was paid in across all of those different accounts, making the average just over £1,200. But with that 1.5 billion, there's a bit of a warning klaxon. It alludes to what Laura was talking about. 42% of that money went into the cash version. So when you consider that these accounts are locked up until the child turns 18, potentially a very long time for the youngest children, that could mean that they are potentially losing out on investment returns and, going to be subject to inflation and the ravages of that on long-term cash. So I think, the message, I often say this phrase a lot, put your own mask on first. So some people will rightly sort out their own finances and ISAs if they aren't near that own £20,000 ISA allowance. And actually, if they're not anywhere near using that, they might prefer to use their own ISA to start saving for a child if they can trust themselves not to splurge it. So another reason they get a thumbs up from me is, whilst the parent has to open and manage a junior ISA, anyone, like grandparents, for example, can pay the money in. It's treated as a gift to the child. And we are seeing people think about gifts for other reasons at the moment. A potential not sure or thumbs down for some people is the thought of a child getting access to a big pot of money at age 18. They might just be projecting their past life choices at 18 onto their kids, though. If you think about how the costs of things like university or saving up for your first home have absolutely skyrocketed, I think we've got to have a bit of trust in the young people. God, I sound really old saying that. And also one final point before you cut me off. Research amongst our AJ Bell customers a few years ago showed that less than 1 in 10 of our junior ISA holders actually cashed their account out when they reached 18. So big thumbs up for our customers there. I think getting children involved with investing and thinking about goals is only a good thing, and it'll help them feel more engaged and more likely to probably carry on investing in their accounts when they get control of them.
Yeah, I couldn't agree more. I think, teaching your child about that junior ISA pot, if they've got one, and how it's been invested and how it's grown over time is a really great first lesson in kind of investing and saving. So Dan, now we're going to go back to you for the turn of the innovative finance ISA. Such a mouthful to pronounce, and also not super widely used, is it, Dan?
No, it definitely feels like the odd one out when you're looking at sort of the range of different ISAs you've got. I mean, it's designed to hold more long-term, less liquid investments. So stuff like peer-to-peer loans, matching up investors with borrowers who could be individuals, or it could be like a business or a property developer. Essentially, because you're cutting out the bank when you invest your money via sort of peer-to-peer stuff, you traditionally get a higher rate of interest than you might find in sort of traditional savings accounts. But I would say that they are quite complicated. They certainly are not a mass market product. Charlene, you mentioned about some of the stats that you've got from HMRC about take up of it. I was having a look at this as well. It looked like there was 3.8 million people saved into a stocks and shares ISA in the most recent data, which is the 22-23 stuff. Only 17,000 people invested into an innovative finance ISA. That seems incredibly low. And I just wonder, I don't know. It's just a sort of thing that if you're going to tidy up the world of ISAs, I think the world could live without this one. I think it's not really understood very well, and it's not actually probably the type of stuff inside is some of it's high risk and just not really suitable for a mass market.
Yeah, Dan, I think very, very underused, isn't it, or niche product. But last but not least, we've got the lifetime ISA. So Charlene, I was going to say give us the sales pitch in less than 30 seconds, but whilst it's a very useful account, it's quite tricky to explain, isn't it?
Right, well, I'll take the challenge. It might not be 30 seconds strictly, but so thumbs up for me on lifetime ISAs. They're great because of the 25% bonus you get on what you pay in. So your maximum limit a year is £4,000 a year included in that overall ISA allowance, and that's automatically then topped up to £5,000. So that is the same value as the tax relief top up you get when you pay into a pension like a SIP. And, maybe it's an easier way of understanding it. So first-time buyers are the main kind of target for this kind of product, but you've got some quite strict rules to adhere to. It's also really useful for retirement for particular groups. So I'm thinking here of self-employed people saving for retirement, and others who've perhaps maxed out their higher rate pension tax relief, and maxed out their available employer pension contributions. And, they like the idea of some extra tax-free cash from age 60. But there is a very big but. Thumbs down on the lifetime ISA, a massive penalty if you take your money out before age 60, and it isn't for that qualifying house purchase. Now, we've seen some groups of people, particularly sort of London and the Southeast, but not just there, start to get unstuck with that property price limit that's currently £450,000. That limit needs to go up, frankly, and also that massive penalty, that 25% penalty, that needs to come down and come down quickly. There's also perhaps an argument, whilst I do love the lifetime ISA when it's used correctly, does an extra ISA product also make all things ISAs that little bit more complicated than they need to be?
Thanks very much there, Charlene. So now it's time for a little bit of a fun bit of the podcast. It's our ISA quiz. So we've got our special guest, Quizmaster Tom Selby, joining us today. So Tom was responsible for probably one of the most chaotic episodes in the history of the Age of Bell podcast. So some bright spark amongst us on the team thought it'd be a good idea to invite him back again to relive that quiz. So, Tom, I don't know whether I live in fear or happiness that you're back.
I'm just glad that by popular demand, the ISA quiz is back 6 years after the first time I did the quiz. So clearly went down an absolute storm then. And this quiz is even better than the last one. So has everyone got their pens and pads handy? Are you ready? Okay, question 1. What was the ISA limit when it was first launched in 1999? A, £5,000. B, £6,000, C, £7,000, or D, £10,000. I'll give you a moment to have a think. Go on, Laura, what have you got?
I am guessing. I think £5,000.
Got £5,000 from Laura. Charlene?
I was going to go with 6, but honestly, that's just a guess.
Dan?
The answer is A, £5,000.
You are all incorrect. The answer is £7,000. So on we go with the second question. Now, this one is one that I know Laura, who is a massive sports enthusiast, is going to get easily.
Right, I'm going to have a cup of tea.
Willie Isa was a world-famous international sportsman who retired in January this year. What sport did he play? Was it A, football, B, rugby league, C, cricket, or D, was he a swimmer?
I'm going to go straight in. I'm going to go with cricket because you like cricket. Therefore, I think it might be a cricket question.
Dan?
Rugby league.
Charlene?
Rugby league, I think.
Dan and Charlene are correct. He was a rugby league player, Samoa International, and he retired from Wigan Warriors. Question 3. Mount Isa is a city in which country? A, South Africa, B, Australia, C, South America, or D, Canada? I've just realised that South America is not a country, so you can all pretend that C doesn't exist.
Bringing the chaos.
Charlene?
I'm going to go for D. Again, no idea.
Okay, Dan?
It's in Australia.
Very confident,
Dan
Laura?
says his answers with such confidence.
Do you back
I'm
that
going to
confidence?
say no. I'm going to say South Africa, but I also can't remember all of the options you gave me. I've gone blind with panic.
Always back the confidence of Dan Coatsworth. It was B, Australia.
It's easy to be confident when you're Googling it behind the scenes, hey?
Everyone ready to is everyone ready to find out who is wheat and who is chaff? Because you are going to be separated right now in these next 3 questions. It's another sports one. It's another sports one for you, Laura.
Oh,
What is the name of the former England women's cricketer who is now a frontline international cricket commentator? Now, remember, ISAs link all of these answers. Does anybody know the answer?
I do.
So this isn't even multiple choice?
No.
Oh, my goodness. Okay, Dan, you go first, and then I might have a flash of inspiration.
Her name is Isabel. Isabel.
That is incorrect.
I honestly thought Dan knew it again. I'm just totally captured by that confidence. I don't know. I mean, Charlotte Stocks. There we go.
Charlotte Stocks is correct. No, that's not correct, unsurprisingly. Laura, do you want to have a stab in the dark? I don't think you're going to get this one.
Is her name Tax-Free Allowance?
It wasn't what I was thinking of, but that is a famous England women's commentator. No, it's Issa Gua. Issa Gua. Okay, so that was a tricky one. Now, the next 2, you should all be able to get, but I'm not sure you will be able to. So, this is question 5. AJ Bell is a member of a trade association called TISA. What does TISA stand for?
Tax Incentivized Savings Association.
Incentivize.
Yeah, let's
Savings
just shout out. Yeah,
Association.
fine. So, what did you just shout out? Tax Incentivized Savings Association, Laura.
Yeah.
That's incorrect. So you're out. You're out of this round. We're making up the rules as we go along.
Okay.
Anyone else got a guess or no?
Silence.
Tax Investment Saving Association.
Charlene, do you want to have a stab in the dark or?
Well, I thought Laura said organisation at the end, not association, but I thought it was Tax Incentivized Savings Association, if I'm honest.
The answer is the Investing and Savings Alliance. Now,
They've changed their name, surely.
Well, question 6. Tizer rebranded in 2019 to Tizer. What did Tizer stand for before this rebrand? So it's now called the Investing and Savings Alliance.
I refer you to my
something else,
previous answer.
which
Tax
was
Incentivized Savings Association, which is actually quite hard. I can see why they rebranded. It's tricky to say.
that is correct. Well done. And that's
I think
the end
that's my
of the
first
quiz.
point.
Yeah. So have you all been tallying your own scores, because we're doing this remotely, so we're going to have to do this based on trust. So can everyone don't shout out, actually, that'll be very bad for the podcast. Everyone in order say what their score was. So let's start with you, Laura, as you're first on my screen.
I've only got 1.
You've got 1. Okay, we've got a starter at 1. Could that be the winning score? I doubt it. Charlene.
I think I got 2.
2.
Because I got Rugby League and the last Tizer, although I think they might terminate my membership.
I trust you. Dan.
I have 2 correct answers. We need a tie-break question.
So it's a draw. And are you ready for your prize?
Yes. Well, I think for our listeners at home will be jumping up and down saying they want an outright winner. So on the spot, tiebreaker question.
You want a tiebreaker question? Okay. Let me just dig into my files. So this is an on the buzzer. You don't have a buzzer, so shout out. Whoever shouts out the answer first, out of Charlene and Dan, wins an as yet unprocured prize. Junior ISAs were also introduced in 1999, but what did the junior ISA replace?
The Child Trust Fund.
Charlene is the winner! There's balloons and things streaming down here. Charlene has gone absolutely crazy. How do you feel, Charlene?
On top of the world, Tom. Thank you.
Is this one of the best moments of your year, of your life?
Maybe today.
Yeah. You have had children, so that would be quite offensive to them if winning an ISA-based quiz was a bigger moment than their successful births.
I think the listeners will be jumping up and down, wondering what on earth's going on here.
So see you again in 6 years. Is that the plan?
Yeah, I think that's the amount of time we need to recover.
I'd like to query that last thing. Are you saying that the junior ISA was introduced in 1999? Because
it was 11 years ago, actually.
Was it?
Junior ISA.
Okay, so in which case you're correct then. I can say I thought you said 1999. I thought that's not right, is it? Child trust funds were around in the mid.
And no one likes a sore loser.
No, so I'm very happy you won.
I think Tom did say they were introduced.
I think I did say 1999, but we're going to have Charlene as the winner anyway.
Let's just cut Dan's query, please.
How many factual errors are there in my questions?
Is that another question? Thank you so much, Tom, for joining us.
Don't rush back.
Now let's talk about where the AJ Bell ISA customers have been putting their money this year. Dan, what is the data showing?
Oh, it's really interesting, actually. I split it into funds, investment trusts, and shares because there's different sort of different takeaways here. So funds, the very sort of dominant trend here was to put money into passive funds. So for those who perhaps don't know, that's a fund that just tracks a certain part of the market. what's not popular, certainly among the most popular funds, are active funds, which is where you have a fund manager who's actually making the decisions about what goes in and out of a portfolio. So it seems to be the more people are turning to these passive funds, they're typically lower cost. They're kind of just an easy way to get exposure to specific parts of the market. You don't have to worry about a fund manager beating the market. You're simply happy just tracking those markets. So some of the popular names are Fidelity Index World, which is just a basket of companies from around the world. Vanguard's S&P 500 ETF, which is tracking the US index S&P 500, and also the Royal London short-term money market. So this is where people have been looking for sort of cash equivalent investments that they can hold in stocks and shares ISA. I think lots of people over in recent years have been put some of their money away in cash because you can get fairly decent return, but those cash rates are now trending downwards. So I think people are looking to what can they hold in the sort of investment ISA, but still potentially get a fair sort of yield from it. Now, with investment trusts, income was the dominant theme here. I totted up the average yields. Average yield you could see from the top 10 most popular trusts, and it came out an average of 6.7% yield. So what's really interesting, that's almost twice the 3.4% yield you get on the FTSE 100. So people are clearly using investment trusts in their ISAs as a source of income, going to names such as City of London Investment Trust, 24 Select Monthly Income, and the JP Morgan Global Growth and Income. When we come to shares, this is a bit different, and so this to me looks like more opportunistic purchases. I wonder if people perhaps are using say a pension for more long-term investing. They might be using their ISA to I've heard this strategy described as play money. They're just trying to make quick gains. I wouldn't say play money is not the correct term to be using at all when you're talking about anything to do with investing. But it clearly been, if you look at what the people have been buying, they're taking perhaps high risks, that contrarian views. Names like John Wood is on there, which is a oil resources services company. Has been really beaten up, had lots of bad news. You had JD Sports been pretty weak, Taylor Wimpey. These are all sort of names where they've suffered either directly or because something's happening in their industry, so they're slightly out of favor. So perhaps people are buying them in the hope that they will rebound. Something will happen to drive those share prices back up. Nvidia is on the list. That's the only one from the Magnificent Seven group of sort of US tech stocks on there. And then otherwise, it's sort of names that are sort of high yielding stocks like Phoenix, which is we've seen this on the sort of popular list for quite a while. They're just it's a retirement savings group, and it's a real generous dividend payer. But it's I thought that was pretty interesting to see sort of different styles depending on what the investment product type was, that what it sort of implied what people are up to and how they're thinking.
So everybody wants to know the secret to becoming an ISA millionaire. Laura, what are those key ingredients?
Yeah, so this is one of my favorite times of year where I get to delve into the portfolio of our wealthiest ISA customers. So these are what we call the ISA super investors. So for stocks and shares ISAs, it's those that have got £1 million or more in their ISA. So this is those that have really saved up over a long time. And it won't surprise you to know that the secret really is making regular contributions, maxing out that ISA allowance if you can, and a long term of saving, investing even, and compounding of those returns over time. So sadly, I'm not here to deliver a get rich quick scheme where you can become an ISA millionaire in the space of 2 years. Actually, the average age of our ISA millionaires is 70. So that shows that a lot of people will have been using things called PEPs, personal equity plans, which were what was in place before the ISA, and then they would have rolled that over and been investing over decades. But that's not to say it's not possible for younger people. So the youngest ISA millionaire that we have is 35 years old. So it is definitely doable. might be for that person that they had a junior ISA, like you were talking about earlier, Charlene, and then that rolled into an adult account. So could have had a much longer time horizon than you would think of for a 35-year-old. And there's actually a handful of ISA investors who are in their 40s and have got portfolios worth £3 million or more. So that should give some hope to younger people out there. But there's no getting away from the fact that you need large contributions each year to get to this level. So it would be the likes of someone maxing out their ISA allowance at that £20,000. There's some common holdings if we look into the portfolios of our ISA Millionaire. There's some common things there. We've got Shell, we've got Lloyds Banking Group, we've got oil giant BP. There's a lot of very recognisable names among the top holdings there that won't be any surprise to anyone. And actually we see quite a split. We see lots of people who are having more proportion in shares. We have some people that have really taken a very high risk strategy and backed a handful of stocks, and they have obviously won out. Obviously, for all of those people that backed a handful of stocks and became an ISA millionaire, there will be lots of people that backed a different handful of stocks and didn't fare so well. So it's not necessarily an advisable strategy, but that is how some people have really put the rockets under their wealth. On average, though, ISA super investors have 25 different positions in their portfolio, but it really ranges. Some have over 150 different investments in their portfolio, and others just have one. So there's no clear plan of how to do it other than lots of contributions, long time horizon, and making some savvy investment choices, which we all need our crystal ball for, obviously.
Right, thank you, Laura. So we've had lots of listener questions come in about ISAs. So let's tackle 3 questions from the post bag. So Charlene, hang on, I'll dig one out. So I've got a good one here, kick things off. So Ita asks, which is better, an ISA or a pension? That's a tough one to answer briefly, isn't it?
Yes, trying to keep me on track with the brief there. ISA v pension, I mean, do get asked about it quite a lot. So we obviously love both of these tax-free accounts. Which is best really depends on what you're investing for. So I've said investing here. So whatever your goal, we are talking with investing medium to long term. Very quick rule of thumb, maybe 5 years plus. So if you're investing and saving towards retirement, then a pension is usually the best place to start. So most employed people will be in their workplace pension. But for people topping up their pension pots, pension savings, and investing, a SIP offers tax relief on the money you pay in as well. So the provider claims basic rate tax relief of 20% automatically. That's the same as the lifetime ISA bonus value. But if you pay higher or additional rate tax, or that's income tax, I should say, on your earnings, you can claim even more tax relief back too. It just reduces the cost of filling up your pension. So all good there. Another plus point for the pension is the limits for most people are higher than ISAs. So potentially up to £60,000 a year as your annual pension allowance, but your own kind of maximum what you can pay in from your earnings will depend on those UK earnings. So it's a trickier question to answer than it should be, that one. Then when you come to access the pension, up to 25% can be taken tax-free and the rest can be used to give you a taxable income. But you won't be able to access the pension until age 55. That's going up to 57 from the 6th of April 2028. So for most people sort of not already in their mid-50s, it will be going up to 57. Now, for goals where you'll need your money before then, but you still want to get in on the kind of tax-free action, ISAs are great. You don't get that upfront tax relief boost, but when you come to access your ISA, which you can do pretty much at any time, your whole pot is tax-free. So that's why we love them. That's why, we love the Stocks and Shares ISA, as you alluded to earlier in the program. Now you get a generous £20,000 allowance, and that's across all your types of ISA. That £20,000 allowance does include anything you pay into a lifetime ISA as well. So just keep an eye on that if you are paying into one of those. There's no limits on the amount you can build up in your ISAs or your pensions anymore, but those pensions do have a cap on that tax-free lump sum you can take. So that cap is set at a really weird figure of £268,275 for most people, and that's just that kind of cap on that tax-free amount. Anything else, you've got over and above that 25% tax-free amount, if you've hit that cap, you can still take it. It will just be treated as taxable income. Now, personally, I think often it's not a question of either or. Like a blended approach tends to work well. It can help you make the most of the allowances and the tax reliefs on offer.
Thanks, Charlene. So, Laura, give me a second while I rummage through the mailbag. Okay, here's a good one. Aaron asks, what is Bed and ISA and should I bother with it?
It's such an awful bit of industry jargon, a bed and ISA. If we had a jargon klaxon, I would be sounding it now. But put simply, a bed and ISA transaction is where an investment is sold in your dealing account and then rebought in your ISA. And it's a service that a platform offers where they carry out that transaction in one go. So otherwise you would need to sell the investment in your dealing account, wait for that cash to hit your account, transfer that cash into your ISA, and then rebuy the investment in your ISA. And obviously, because that process would take a bit of time, you'd be out of the market, so you wouldn't be invested in that. And if you were very unlucky, that might be the time when that investment rocketed up in value. So it carries it all out in one seamless transaction. And also with lots of platforms, including AJ Bell, you'll only pay one dealing charge for even though you're selling and then rebuying. So it's a very good way of moving money from your dealing account, which obviously doesn't have the tax perks of an ISA, into your ISA account. And what we've seen in recent years is obviously we've talked about a lot on the podcast before, your capital gains tax allowance has been reduced, rates have been increased, and your dividend allowance has been reduced. So that means that your investments sitting outside of your ISA, so in your dealing account, might be facing a higher tax bill if you've got gains on them or if you've got income coming from them. So we have seen lots of people making use of this bed and ISA transaction so that they're putting more of their investments into their ISA so that it can grow free of tax. So it's definitely a savvy one to look at if you've got a dealing account and that you know that you're going to be paying tax on some of that money.
Thanks, Laura. So we just got time, one more question. So Charlene, I won't name the person who sent in this question in case they get in trouble with the taxman, but I sort of quote, unquote, name withheld asks, how does the HMRC know if I go over the £20,000 annual ISA allowance?
Oh, right, good one. Is it one of the team, maybe? Right, look, nice try if you're trying to game the system here, I think, when you're saying how do they know. But the answer is that HMRC will catch up with you eventually. So this is a potential issue for people who are, really looking to pile money into ISAs, because you can now pay into multiple ISAs of the same type each tax year. So previously you could split across the different types, but you couldn't pay into two stocks and shares ISAs, for example. So keeping track of that £20,000 now, if you are looking to max out your allowance, is a little bit trickier. But all the ISA information is reported by your ISA manager or provider to HMRC. So that will eventually ensure that you have not put too much into the tax-free accounts in their eyes. And even if it is an innocent error and you don't spot it kind of in the tax year itself, HMRC will eventually see it and they will make contact with you. It feeds through to that time lag I mentioned earlier in the episode. Those returns are done sometime after the end of the tax year, so it might take some time, but they probably will catch up with you eventually. Now, if you've done this really recently, in the run up to the end of the tax year and perhaps accidentally, you might be able to sort the issue with your most recent provider that you've paid the money into, but please speak to them first. That they might have to advise you that you have to wait for HMRC, but it's always worth trying to get in contact with them.
Well, brilliant. Great questions that we had. Thanks ever much for sending those in.
So loads of great ISA material there, which I hope everyone has found very useful as we scream towards the end of the tax year. But before we finish, we've got one more guest for you. So Craig Baker is from the team behind Alliance Witan, which is the newly merged company created from the marriage of Alliance Trust and Witan Investment Trust. So Alliance Witan has just published its first set of results as an enlarged business. And Dan caught up with Craig to find out how it's going on, as this is one of the most popular trusts held among AJ Bell ISA customers. So let's hear what Craig had to say.
So, Craig, obviously we've got the results out from Alliance Witan, first time full year results since the merger, but obviously it's not the performance period doesn't cover the entire time that the two trusts have been together. I mean, just I guess how's performance going, and is it possible to sort of just isolate the performance of since the two companies have come together?
Right. So as you say, the combination of the two trusts happened in October 2024, and yes, we're announcing the full calendar year for 2024. So really, only about the final 2 months of that was as the combined entity. The performance over the full year, as was announced, was another strong year in absolute returns. 14.3% shareholder return, 13.3% net asset value return, following another very strong year the previous year, over 20% return in 2023. And indeed, relative to peer group, pretty similar over the 1 year, very strong over the 3 years. But relative to the MSCI All Country World Index, which is the index benchmark that we tend to use, underperformance for the calendar year of 2024 in contrast to outperformance in calendar year 2023. So over the 3 years, still ahead of index, but behind the very strong return from the index of 19.6% for the calendar year of 2024. So that's some sort of 6% at NAV level underperformance. About half of that, well, just over half of that, came from being underweight large stroke mega cap companies and a bit overweight the bottom end of the large cap universe and overweight the mid cap universe. So that was over half of it. There were then stock specific things really outside of that. Nvidia was the biggest negative contributor, and by that I mean it was a positive contributor because we did hold some, but it was negative in relative terms because we were significantly underweight the index in the second half of the year when it continued to do well. So we were actually overweight Nvidia for quite some time, and then moved from overweight to underweight near the end of the first quarter, and it continued to perform well through 2024. Obviously, we've seen something a bit different to that in the last few weeks, but certainly for the 2024 numbers, that was the biggest negative contributor, followed by a couple of other underweights like Tesla and Apple, which did well, and Broadcom for that matter. But there were one or two stocks that we held that did less well, like Novo Nordisk being probably the most significant on the overweight position, but actually we remain very positive and added to that position. To your question of what about since the combination of the two, is really just a 2-month period in that 2024, so I wouldn't read too much into that. And of course now a couple of months into 2025, certainly this year 2025, pretty much for the first 2 months in line with the benchmark. So not a significant outperformance or underperformance since the combination.
Because I was looking at some of the commentary around how the portfolio has slightly changed, and just in terms of, it looks like you've been buying some stocks in the tobacco, healthcare, or telecom sector, or sort of increasing positions if you've already got them, and potentially reducing positions in technology and things like oil. Does that sort of indicate that you think we might have a tough year this year in 2025, and so perhaps you're better to be in defensive type companies rather than sort of these sort of go growth which you might find in the tech sector?
Yeah, I mean, ultimately we try and keep the portfolio very balanced and not having any significant style biases at any point in time. Just as a reminder, we purposely try and make stock selection drive everything in the portfolio as much as we can, and so we eliminate most style biases. The one bias we tend to structurally have is slightly underweight the mega cap and large cap, and overweight the lower end of large cap and mid cap, and that's really comes from this point that we ask each of the stock pickers to just pick their 20 best ideas maximum. And so it's unusual that they would find all of the very largest stocks in the world that are the most highly covered by the brokerage community and have by definition gone up the most in recent years, to find them as all of those as their best ideas. So you structurally end up with a slight underweight that, but otherwise we don't really have big value or growth biases, the defensives versus technology and the like. Some of the changes in the portfolio over the period, though, come from two angles. So one is the underlying stock pickers tweaking their portfolio, and there's definitely been a continued reduction in our weighting to the Magnificent Seven, for example. And we're now at the largest, pretty much the most significant underweight we've been relative to the index in those. That's changed a bit over time. We've on average been underweight through the whole period we've been running since 2017. There was a small period where we were overweight actually in 2020, but generally on average we've been slightly underweight, but we're the most significantly underweight today. So there's been a little bit of change in the portfolio, as you say, from that, taking some profits in some of those stocks and reinvesting in some others where it's felt that some of these companies are doing incredibly well from a fundamentals perspective. They're delivering great earnings through the period, beating expectations in many cases, and yet that hasn't been fully reflected in share prices yet because the market's been focusing on a pretty narrow area for some time now. So yes, there's definitely been some switches from the stock pickers along those lines, but it's also worth remembering that there were 3 manager changes in 2024, which will impact that a little bit as well. Now, just to be clear, that wasn't us leaving a growth manager and going into a value manager or anything like that. We've kept those style biases the same, but nonetheless, it has implications on individual stock positions. So we changed Ben Whitmore at Jupiter, who announced that he was leaving Jupiter in early 2024. We came out of there and moved that money to Ramakrishna at Arga. That was in the early first half of 2024. And then at the time of the combination in October, when we were doing the transition with the portfolio, we did 2 things. First of all, we brought in one of the managers at Witan that wasn't at that point in time in the Alliance Trust portfolio, which is Jennison. That's a manager that we've liked at WTW for a number of years. In fact, we use them in some of our other portfolios. And so a great opportunity to get them in at no cost, because we could just bring the stock across in specie and not incur costs of that transition. So we did that. And then we also, at the same time, because we had a transition manager in place helping us keep the costs down, we took the opportunity to make a more business as usual change of one of the stock pickers. So we replaced Black Creek, who'd been in the portfolio since we took over in April 2017. We replaced them with EdgePoint, who came in at that point in time. So some of those manager changes combined with some of that profit taking in some of the Magnificent Seven and some other companies that have done particularly well were what really led to some of the changes that you referred to.
I mean, you made a comment earlier about the Magnificent Seven, sort of you're sort of perhaps stepping away a bit from the exposure to that area. I mean, it does seem like that's the bulk of those companies are sort of not doing as well on the stock market, certainly compared to the last couple of years. Do you think this is they've had their moment in the sun, and perhaps the market is looking for something else now?
Yeah, I mean, there's a couple of things to say about them. I mean, the first is to say that although they quite often just get lumped in as a homogenous group, there's some big differences between the individual companies within that. And so, we're overweight Amazon, for example. We have significant holdings in Microsoft, Meta, Alphabet, but we have nothing in Apple and Tesla, and we're now pretty significantly underweight Nvidia. So there's a bit of a mix amongst those groups. The reality is that these are wonderful companies that have are very diversified in their businesses. They are continuing to produce good earnings generally. I mean, there's differences between them, but they're producing really good earnings. It's just a question of whether that's fully reflected in the share price already, or more than fully reflected in some cases. And so, in if you're a manager looking for, I just want to hold my 15, 20 best ideas in the world, when a lot of those have seen very considerable share price appreciation for some time, it's harder for them to be making it into those very best ideas. And so that has led to some sales in those. And then the other thing is, if you're not holding a few stocks and they've continued to perform incredibly well, your underweight position just naturally becomes bigger as they become a bigger part of the index if you still don't own them. And Apple and Tesla are two stocks that we've occasionally had a small position in Apple, but generally we've had zero or very close to zero in those two stocks for the whole period that we've been managing the trust since April 2017.
Yeah, I mean, obviously, I guess take a step back. Why would someone want to buy shares in Alliance Witan? It's simply to try and beat the market, get exposure to a range of managers' best ideas from around the world. The fact that you've made this merger of Alliance Trust and Witan, that hasn't changed the strategy, has it?
The strategy is completely unchanged. That's absolutely right. In fact, it just gave us a bit of an opportunity to bring in a new manager in Jennison at zero cost. But the strategy is unchanged. Pretty much the manager lineup is exactly as it would have been without the combination with Witan. The big difference really is that being now at a £5 billion plus trust, that has a few advantages. Firstly, in the first FTSE rebalance after the combination, we were elevated into the FTSE 100. That happened in December, which has a few implications. That first is that it just ups your profile, which is a positive and can have a positive impact on your discount, which ultimately has an impact on total shareholder return. But it also increases your liquidity as well, which just makes the trust even more attractive to more investors than it would have done historically, particularly if they look at the fact that we've had a stable discount for the whole period that we've been in place. The board have continued to do share buybacks where they've been necessary, but actually very few share buybacks have been necessary to keep it at a tight discount. So that's all a positive for the trust. Obviously, being a bigger entity, you can also spend a bit more on ensuring that retail investors are aware of what you're doing, and so you can do more on the marketing side with that being a small proportion of the costs of such a large trust. So that's beneficial as well. So all of that was helpful, and actually we took the opportunity to increase the dividend as well, such that it's a 6% increase year on year. The 58th year in a row of increases for Alliance Trust investors, the 50th for Witan investors, who saw a 4% increase on their dividend from 2023. So all of that was really the positive thing. But as you say, that the real attraction of Alliance Witan is for investors to be able to go into a trust that is run at relatively low cost because of its size, is something that can be expected over the long term to outperform the index, the peer group, but it's done in a way where the ride should be smoother. So, in investment, the journey is almost as important as the destination. And so being able to do that with a trust that's multi-manager, removes some style biases, so there shouldn't be, it being the best performing 1 minute, the worst performing the next minute. It should be able to produce strong returns over a market cycle. And ultimately, every retail investor really needs to run a multi-manager portfolio. They wouldn't typically put all of their money in one single manager's trust. Here's the advantage that we can do that for the retail investor, and so they can have a one-stop shop that does that, and we can do that getting them access to managers that they wouldn't otherwise be able to access in UK retail space in some cases, and certainly wouldn't be able to access their best ideas 20 stock portfolios. They can only do that through Alliance Witan, and do that at a cost that's lower than they could do directly themselves because of the bargaining power that Alliance Witan has with its $4 trillion or so under advice and a couple of $100 billion under management, and then all done within a single wrapper as well. So we think that there's just some really significant advantages for this being a kind of one-stop shop for any investor really in their ISA or pension portfolio.
That was Craig Baker there from Alliance Witan. And that's everything from us this week in our ISA special. Don't miss next week's show when we've got an investment expert talking about all things interesting and developments in Germany. Until then, thanks for listening. And we'd really, really love it if you could leave us a review of the podcast wherever you listen and download your pods from, if you haven't already done so. Thank you and bye.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.